Hi everyone, and welcome to Frank Talk on Mortgages. I'm Don Scott, the CEO of Frank Mortgage. Today we're going to talk about the characteristics of you as a borrower in your mortgage application that make you eligible for the lowest mortgage rates in the market. You may have seen really low rates advertised. Don't really know if you can qualify for them, and some of you maybe have gone through the process of getting a mortgage, gotten fairly far along, and then found out that you weren't eligible for those rates. You're actually only eligible for a higher rate. It's a bit frustrating. So it's good to know going into the process what the characteristics are of a borrower that make them eligible for those rates and whether you might possibly be one of those borrowers. So let's go through those key things. There's 5 of them. The first is your down payment. You need a down payment to get a mortgage, period. If your down payment is between 5% and 20% of the property value, you are eligible for an insured mortgage loan. There's an insurance premium you have to pay. It gets added to your mortgage typically. But the good news is that the lowest mortgage rates in the market are insured mortgage rates. So when you see those really low rates advertised on websites, those are typically insured mortgage rates. If your down payment's greater than 20%, you would qualify for a conventional mortgage, low LTV mortgage. And those rates are usually higher than insured mortgage rates. So if you have a large down payment and you're looking at a teaser rate on a website, you might find out you get a higher rate even though you're a really good borrower with a bigger down payment. But if your down payment is even larger, say 35%, with some lenders, not all of them, you might get even a better rate than you would with the 20% down payment. So the down payment is very important to what you can qualify for. The second is your credit score. For those of you that don't know what those are, they're a number between 300 and 900. It's maintained by a couple of credit bureaus in Canada, the main ones being Equifax and TransUnion. And it's an indicator of your ability and likelihood to pay your debts. So it looks at your history, whether you've been delinquent on any payments, whether you've defaulted on any obligations, how much debt you've had, that sort of thing, and calculates a score. And if that score is over 680, most mortgage lenders in Canada would consider you to be a prime borrower. And if you're a prime borrower, you can often get access to those lowest mortgage rates. The third thing is having stable employment with verifiable income. And what that means is, that you've been in a job for an extended period of time. If you just change jobs, sometimes it's even hard to get approved for a mortgage. They like to see that you have some job tenure. And they want to see preferably that you can verify that income with some documentation. So if you're a salaried employee, for instance, you can show a pay stub and a notice of assessment, that being the document you get back from the tax authorities after you filed your taxes that shows exactly what you made in the prior year. So that kind of documentation is really strong, really confirms your income. Lenders love it, and you can get access to the lowest rates. If you've got a more complicated employment picture, it doesn't mean you can't qualify for a mortgage. You just might not get the lowest rate. If you're self-employed or you're working on a couple different contracts, and there's a lot of paperwork and no pay stubs, and it's a little more difficult to prove your income. The fourth thing is your debt service ratios. And there are 2 ratios that lenders calculate. The first one relates to the cost of your housing. It's the gross debt service ratio, the GDS ratio. And the formula there is basically your mortgage payment stress tested plus 2%. Plus property taxes, plus an estimate of heating costs, plus half your condo fees if it's a condo property, divided by your total income. It makes an assessment of the overall debt burden from that home that you're looking to finance on your finances. The second one is the total debt service ratio, the TDS, which is all of that from the GDS plus your other debt obligations, such as a car payment or a credit card, that sort of thing. And those 2 ratios, there are limits on what they want to see the numbers be. So the GDS, they cap it at 39% and TDS 44%. If your ratios are under that, you can be often, if everything else is in place, considered a prime borrower and eligible for those top mortgage rates. If your ratios are a bit higher, you may not even be able to qualify for a loan with a bank. You may have to go to a B lender or an alt lender to get a mortgage. So those ratios are really critical for qualifying for the lowest rates. And the fifth thing is the purpose of the loan. The lowest rates are available when the purpose of the loan is primary residence, and that means it's the place you're going to live in. If the purpose of the loan is to finance a second home or a rental property, investment property, you're going to get a higher rate. So there's 5 things that are critical to getting access to the lower rates: your down payment, your credit score, your employment and how easy it is to verify your income, your debt service ratios, and the purpose of the loan. So keep those in mind when you start the mortgage process. If you are going to fit the mold for the lenders for all 5 of those things, very good chance of getting the lowest mortgage rates. 2 things to keep in mind though. One is the lowest mortgage rate isn't necessarily the best deal. Yes, it's a low rate, but often those low rates come with very restrictive provisions in the contract. Very limited prepayment provisions, and some of the other nice features you get in typical mortgages like portability may not be present. So make sure you understand the terms of the mortgage as well as the rate to understand whether it's the right deal for you. And the second thing is, where are the lowest rates? If you go to the bank, you might find the rates they have that they can offer you are higher than the rates you might see on some of the online broker websites like Frank Mortgage. And that is true. The lowest rates often are found in the broker network because they have access to a variety of lenders, and the bigger online marketplaces like ours have access to multiple lenders at one time so that we can always find you who it is in the market that's offering the lowest rate on that day. So keep that in mind as well. So if you want to talk to someone at Frank Mortgage or just check us out online, see you on the screen here at www.frankmortgage.com. Call us on the number there. We'd be happy to talk to you and help you out. Again, I'm Don Scott, CEO of Frank Mortgage. This is Frank Talk on Mortgages. Thank you for watching.